It is day 2, like I earlier on mentioned, and right now we'll be delving into the main session for today. And we're going straight into the finance session. And to kick off, I would want to welcome online our speakers. I would want to start off by welcoming the CEO, Zambia National Commercial Bank, PLC, in person, Mukwandi Chibesakunda. The first female CEO, National Savings and Credit Bank, first female president of the Zambia Institute of Banking and Finance, to mention a few. She will be represented by Dr. Patrick Chileshe, the head of economic research, ZANACO Bank, Zambia. We would also be having the presence online, Abubakar Suleiman, the Group Managing Director, CEO, Sterling Bank PLC, who happens to also be the former board member, Trust Bank of Africa, a former Chief Financial Officer, Trust Bank of Africa, and also to mention a few of his criteria. Going forward, I want to also recognize one more speaker, Peter Ashade, the Chief Executive Officer, United Capital PLC, who happens to be the Vice President of the Chartered Institute of Bankers of Nigeria. He is also an associate of the Institute of the Chartered Accountants of Nigeria, to mention a few. Would also have online to join us Dr. Walton Gilpin, the Chief Executive Officer, Rokel Commercial Bank, Sierra Leone, the former advisor to the Commonwealth Secretariat in the United Kingdom, who also is a consultant in the public finance, risk management, liquidity management, and bank sovereign interdependence. And to take us through this session, I would want to also welcome online the Global Trade Advisory Lead, Deloitte, Antouche, West Africa, in person, Chijioke Odo. Ladies and gentlemen, over to you, Chijioke.
Thank you, Moses, for the introduction. Good morning, ladies and gentlemen, and welcome again to the panel session on finance. In this session, we shall focus specifically on strengthening Africa's financial system through and post the pandemic. It is not new that we are still in the middle of a global health crisis that would not abate until we have a vaccine or effective therapeutics. As we have seen, this health crisis has morphed into an economic crisis and is gradually heading towards a financial crisis if we don't deal with it. Many businesses have already shut down and may never come back. While those still surviving would need a bailout, or they could shut down as well. The presence of a strong financial system has never been more important, particularly because of the role it could play in helping businesses survive the crisis and ultimately build back stronger. The state of the financial system
Okay. We're having technical difficulties there with Chijioke, and we hope to sort that out real quick. But ladies and gentlemen, like earlier on mentioned, today would be... okay, we have him back. So over to you once more, Chijioke.
Okay, so I was saying the state of the financial system in Africa, many would argue, is relatively weak and cannot on its own help Africa through this crisis. In particular, many have argued that our system is small, made up largely of banks, has few stocks with sufficient liquidity, and is characterized by high cost of intermediation and finance provision. Against this backdrop, it has become critical that we examine our financial system with a view to looking for solutions to its current state, especially at this time. To help us do this, and as Moses has ably introduced, we have a very distinguished panel from across the continent who come with deep and extensive knowledge about the financial system in Africa. In the next 40 minutes or thereabout, we will be responding to some of the questions we have gathered from various stakeholders across the continent, which we believe will be helpful in getting an insight into the current financial landscape. We would also try to take some of the questions that you have asked on the chat box. So as the session goes on, please include any questions you may have in the chat box, and I'll try to take as much as possible before we close the session. To help us manage the time, I'd also like ask our panelists to help keep all responses within 3-4 minutes, so that we can have as many comments from our participants listening. So we would also have time to take questions, okay? Without further delay, I would like to kick off from where the CBN governor, stopped, and the questions he raised, or, some things he told us to look at. And in my industry, they say where there are challenges, there are opportunities. So I'd like to, take a step back and looking at the pandemic. What are the opportunities? And I'd like to start with, question with Dr. Gilpin. And the question is this: the pandemic advocated social distancing and remote working culture. I can see it appears that you're also working from home. An outcome that added further impetus to the growing trend towards digitalization. For instance, digital service providers, including e-commerce businesses, may have seen a boost in business as brick markets and sitting restaurants are either closed or deemed unsafe. In your view, Dr. Gilpin, what opportunities has the pandemic created for the financial system, and how can businesses or governments harness the opportunities created?
You're muted.
Yeah, thank you. Thank you very much, Chijioke. It's a joy to be here, and it's a pleasure to articulate this discussion on this portal. I believe it's going to be quite beneficial, not only to us, but also the end result can also help us as Africans to deepen and strengthen our economies in the face of an external crisis that also becomes internal. We are not isolated, and we are not insulated either. As a consequence, a situation that is endogenous, as exogenous to us, has become endogenous, impacting our systems. One key function of the financial system is pulling resources together and transferring resources also. As a consequence, the ability to pull resources together means that there has been, and really to a large extent, a lot of human contact and human interaction to get this going. In other words, a lot of our economies are now trying to move from being a cash-based economy to being an e-commerce-based economy. We have found that in so doing, the two functions, which are transferring resources and pulling resources, we have to rely on what we call financial intermediation, also financial depth, and therefore we look at key indicators that do impact these particular attributes. One is basically the M2 over GDP, which shows us financial depth within an economy. We have to also look at financial intermediation, which is the inverse of velocity, which is actually GDP over M2. And now this actually looks at money, time and savings deposits, and currency in circulation. So in order to get the time and savings deposit moving and to trigger financial intermediation and also trigger the multiplier effect, there has to be a way to shift resources around. We have been able to, during the crisis, realize that the use for digital portals has become quintessential at this moment. We have moved into the digital space and try to provide simple access to your funds through your phone, the simple push button phone or the smartphone. Therefore, we are using a lot of USSD codes right now, and also pushing out apps that can give the comfort of the rural man, the rural man, the comfort of accessing his funds from his farm or from the riverside or from the marketplace. And this religion has been moving out to the digital space. That brings with it the issue of security, the issue of cyber fraud and cyber crime. And that brings also the legislators on board in that the financial system would evolve based upon the needs of human beings at a particular time. This need right now has evolved from the pandemic. The legislators have to come on board to ensure that we have cyber security legislation. The competence, the skill set, the human capital has to grow to meet up the rising demands from the sector as far as cybersecurity is concerned. We also need to train the population to be able to utilize the digital portals that we've given to them. That way we can see transactions moving, resources moving, and we can also see the knowledge skill set of the populace growing, the regulator also increasing the potential to regulate the new trend, and also, most of all, the banking sector also responding strongly through connectivity, for the digital applications, and also the telecommunication sector also moving. I believe that the digital space has been really been underutilized, and there is a need now to increase the possibility of utilizing that more. So the banks and the telcos have to work together. The regulator also has to work together, and the key thing is keeping resources moving across the economy, across sectors, and also making sure through the multiplier effect, the banks can continue to play their role from the digital space.
So, I mean, if just to go to your response, if you were to say one thing that the regulators should do to help to harness the opportunities created by this pandemic, if any, what is that one thing that you think if regulators are able to do, we'll be able to see an explosion, an expansion of the economy and the system itself?
Yeah, I think the regulator would have to put in place, either we call it regulations or laws, to make it safe and easier for the banks to become more aggressive in the digital space. That is an emerging area. And I think also the issue of cybersecurity, the issue of account opening process, the issue of the KYC, all those take a different tone when you utilize the digital portal. And so probably there has to be a look at the KYC issues to make sure that all the compliance issues are met, but at the same time, give the banks the leeway to be able to open accounts through the digital portal without violating any major rules and without exposing the system to potential risk. On the issue of cybersecurity, the regulators have to come in strong to ensure that financial institutions could have firewalls that are robust enough to safeguard the deposits and also the integrity of the system over time.
Thank you, Dr. Gilpin. You mentioned something that we will come to later, and that's about KYC and data collection. But I'll still like to stay with you then, Dr. Gilpin. Let's see, I'd like to touch on this point of opportunity. And if we were to look at from a Pan-African perspective, you look at Africa now is currently preparing for the launch of the African Continental Free Trade Area, the AfCFTA, which is the largest free trade agreement since the establishment of the World Trade Organization. Africa aims to use the AfCFTA to drive industrial expansion by incentivizing value creation in Africa. Now, there has been a lot of talk about using the AfCFTA as a post-pandemic reviewed level, and negotiators across Africa are currently negotiating on the final bits, as we aim to start, the AfCFTA in January 2021. Do you agree that the AfCFTA can be used as a post-pandemic rebuild lever? And what do you think the role of the financial system would be?
Thank you ever so much. I think there are a few areas that I'll touch on right here. I mean, the whole free trade idea is quite good, but I believe in African countries participating more in the global value chain because there is very little potential in recreating the wheel. Now, for instance, most African economies are maybe agro-based economies and be the push to start. Now, in the event that we want to have a free trade, we can have a regional global value chain or global value chain. And this means that the African countries could be part of the end product, rather than try to reinvent the wheel. I mean, we know in the 80s and 90s, we had the whole issue of the import substitution industry failure. The ISIs failed because the fundamental structures were not in place. As a result, communication was poor, transportation was poor, electricity was poor, security was poor, and so ISIs failed. So if we have to deepen the trade relationship, maybe the conventional trade approach should be looked at. And I think we should move on towards being part of the global value chain, just like the Asian countries have been over the past from the 90s to present. Of course, GVCs dropped around 2008 because of more protectionism coming up after the economic crisis, so on and so forth. But I believe it's a unique opportunity for Africa. Now, coming to the financial system sector, the banks also have maybe got a bloody nose in the agricultural sector before. So maybe another approach to lending for agriculture can be worked out. We can have maybe a package, a subsidy package from the government, of the central bank, with a reduced interest rate and with a longer maturity profile for repayment. And I think also it could be targeted into industries that are going to be part of the global value chain. So what I would summarize with is that I believe that we can look for regional GVCs and then up for global GVCs and piggyback on countries that are stronger in the global value chain right now, like Nigeria, leading cocoa. We have the story of the Nutella cocoa spread. Most of the cocoa will come from either Ghana or Nigeria, and that is about the first step of the larger global value chain. And by so doing, not only will we increase our quality control because the lead farm will be the one who will ensure quality control at the rudimentary stage, but we can also improve the output to the level wherein the returns to our workers would be higher because they'll move up the skills ladder. And I think that approach will help to build up that sector, strengthen the financial system, increase income, and also increase GDP growth in Africa, and also getting Africa on the map through GVCs rather than traditional trade patterns.
Thank you for that. But just before we leave the AFTFTA, many would argue that the regions you have talked about, they started off by consolidating, whether within Asia, North America, Europe, find a way to expand and industrialize as a region first before they moved to creating global value chains. Now, another thing people talk about is Africa has been exposed. If you look at intra-Africa trade, they say intra-Africa trade is 16%. We talk about the pandemic. We say, look, there's a lot that Africa could have produced within Africa and supplied. And you're saying, look, if African businesses are big enough and strong enough and able to produce for Africa, then the financial system will be able to absorb them and be able to give them the levers to be able to expand. What would you say to those who believe that we need to consolidate what we're doing in Africa first, get stronger before we begin to move out outside Africa?
Thank you so much. You see, most pundits would state that maybe regional value chains are a good start, okay? And I would also agree with that. But let us look at the barriers to trade in Africa. Let us look at the transportation issues in Africa. Let us see how we can improve on the infrastructure, the perception of location, the ease of doing business within Africa. And then we can then push it further. I see a lot of that happening right now in West Africa. There are a lot of trade agreements wherein it's easy to say within the ECOWAS region, the Mana River Union region, going down to South Africa, the SADC region is quite strong also, and Southern and Eastern Africa. So these regional blocks can really help. However, I would also say that in order for the strength that will be consolidated in the regional trade to grow, there have to be policies that will ensure that the quality control, all right, the skill set of the workers is at a level wherein it will also attract international, further than the region to attack the global value chain. Because most of the products now that are on high demand, the jams, the jellies, the cocoa spread, most of those products, the initial agricultural produce comes from countries like Africa. So I think whilst we're looking at the region also, I think our eye should be on the global, because that is where I think the money is at, and that is also where the reputation is at. So for me, I would say, okay, yes, the Asian countries actually predicated their trade mainly on the regional initially, but I think they pushed out global real fast, so you see the North Americans were more into the capital-based type of value chain, whereas the Asians were more on that regional value chain. But today, I think they moved from the 90s to date to be more global. So I think Africa should have that forward-looking perspective to things and think that, yes, we are going to start regional, but our aim within the three, I think now we're looking at Vision 2030, Vision 2035. Years ago, we had Vision 2020, and I don't think we met most of that criteria. So going for Vision 2030, 2035, I think we should position ourselves to be global. We can start from where we're at right now, and then we know that, yes, in the next 10 years, we want to go global. That is where we should be, and not only looking at regional, because we need to leave our footprints in the global times of time.
All right, thank you, Dr. Gilpin. Now let's turn to the challenges created by this pandemic. Now I'd like to turn to Suleiman. The stability of the banking sector in Africa is threatened by the expected increase in non-performing loans. Borrowers across various sectors and scales of businesses are being affected. as a decline in income means that they may not be able to meet their obligations. In your view, how do banks manage the increase in loan impairment? And what role do you expect regulators to play?
Thank you very much, Chijioke. When it comes to dealing with the impending non-performing loan crisis, my sense is that it would be a mistake for banks to sit back and wait for the loans to go bad and then deal with it. I think this calls for us to actually deal with the customers and the sectors they are in and figure out a way to intervene to prevent the non-performing loans. Because at this point, the loans haven't gone bad yet. What we have are a series of circumstances that is likely to lead to bad loans. And the right intervention, and again, if you follow from the speech given by the central bank governor, with the right intervention, you can actually prevent the loans from going bad. So this is one instance where you don't sit back in the bank and wait for the real life events to occur and then deal with the consequences. Rather, you step out, meet with the customers and figure out a way to intervene so that the loans don't go bad. Some of those interventions can be in the form of restructuring to improve to reduce the repayment obligation or defer some repayment. In some instances, actually, you enable the customers to access new markets so that they can have a new stream of revenue and therefore be able to repay. The good news, however, is that given the credit penetration in Nigeria, even in the event of a full-blown crisis in the space, the impact on the economy itself is not as big as it would be in countries with much higher credit penetration. And so what has been a problem for us, which is the lack of access to credit, actually does moderate the impact in the financial crisis. So I don't think that there is a financial crisis on the horizon for the Nigerian financial system. I think that there might be some difficulties. But again, if you remember, Nigeria has historically maintained a much higher capital adequacy ratio and therefore has a significant capital buffer. If you add that to the fact that the sector has one of the highest liquidity buffer anywhere in the world right now, I feel very comfortable that the decisions that the banks have made, as well as the policy decisions that the central bank has made, would protect the industry from the worst of non-performing loans in this crisis.
Okay, so the banks are in a good place.
Yes, I feel the banks are in a fairly decent place. The worst case scenario would be a reduction in profitability in 2020 and 2021 and some moderation in available capital for leverage. I, however, worry more about the impact in the macroeconomy, especially how it affects demand going forward. So we might see weak demand if the interventions that we've put in place don't work. So we are motivated to continue to push capital into the system. But of course, as you know, capital alone cannot lead to the productivity and the growth we're looking for. So it needs to be side by side with some policy measures, and I guess with some fiscal and monetary measures. So when you combine those, we should be able to see the economy move from a negative growth to positive growth, hopefully, if not in the last quarter, certainly by Q1 2021.
Great. I mean, that's comforting. So, but let's now turn to African countries. Okay, Dr. Chileshe, many African countries are entangled with series of debts accruing to developed nations. What threat does this pose Africa's COVID-19 recovery plans? How should the leadership of African countries respond to these threats? What could donors and development organizations do to alleviate the pain? I think you're still muted. Dr. Chileshe, you're still muted.
Thank you. Thank you very much. Really, what you've alluded to, Chijioke, is a very critical issue for most African countries at the moment. Quite a number of our countries have been negatively impacted by the outbreak of the COVID-19. One issue you are going to see, and something that the central bank governor did mention earlier, is that the revenue systems of most governments in Africa have been negatively impacted either through a reduction in business activities, which has had to, as a result of restrictions that were instituted to fight the COVID-19. Other routes have been the negative impact on commodity prices. The governor did mention, of course, that Nigeria itself has had to grapple with the reduction in revenues as a result of the non-recovery in crude oil prices on the international market. Quite a number of countries, as a result of this, are actually facing a number of challenges. Many of you are now, it's in the open, the challenges that the Zambian government is actually facing with regards to service its external debt because of the crippled revenue systems that has occurred as a result of the COVID-19. Additionally, you find that most of our currencies have actually been depreciating against major currencies, and that is actually even exacerbating the issue of debt service. And what we've seen is that most countries are now facing challenges with meeting social expenditures. We've seen our own government actually go aggressively trying to limit the levels of expenditures on the social services. And I guess that is a space that development organizations as well as donors need to cover. Because what you are going to see is a number of African countries, especially the poor ones, actually are struggling with finding resources to make to service the huge debt that it has with developed nations. At the same time, they have to spare some resources to spend on the health systems, the education systems, as well as social spending for purposes of poverty alleviation. Now, in that instance, we need to have donors on board. We need to get donors on board as well as our development partners to come together and probably come up with resources to help these countries deal with the fallout from the COVID-19. Now, for many of the development partners, I think the most important thing is, surrounds trying to work with these countries to manage their internal, to manage their debt exposure to developed countries, as well as emerging countries. Zambia itself is not only exposed to debt with developed countries, we have quite a lot of debt with other emerging market economies. A good example is China itself. So one thing that I think we need to find out is that countries need to work together with development partners to come up with more sustainable debt management systems to help these countries to recover from the COVID-19 pandemic. For African leaders, it's very important, I think, for us to start thinking of developing resilient systems that are able to withstand the negative effects of external shocks. It has become, I remember Dr. Gilpin was mentioning the fact that it's very easy for external shocks actually to become more internalized on the African continent because of our weak systems and probably our larger exposure to external markets. So this is a wake-up call to African countries to try and come up with systems which can make these economies to become more resilient to external shocks and be able to withstand. Zambia itself actually suffered a lot in the sense that when the West, as well as much of China, instituted their own COVID-19 measures, the supply systems were disrupted quite a lot. And this had a very big impact on our country. The prices, Zambia is one of the largest importers, I think, on the African continent. Much of its consumer goods are imported, and these were negatively impacted, and we could clearly see inflation start running away from us. We were entering the 2020 with inflation around 9–10%. Inflation quickly ran to about 15. We are now at 16%. And all this is because of the disruption in global supply systems. And that is really critical for African governments to try and think of mechanisms that can be developed to actually help the continent to be more resilient against external shocks.
Right. So you would agree that a stronger African financial system would help African countries during and post the pandemic. And you think
yes, Chijioke, that is very, very important. We need to have a resilient African-based, a strong African financial system, in the sense that during economic turmoil like the one we have now, you tend to have difficulties accessing capital on the global financial market, because you find that most of your countries are downgraded by sovereign credit rating agencies. Zambia itself was rated selective default, and it is very difficult for an African-based financial institution to actually access global capital markets for on lending into the domestic financial markets. So in that regard, we need to have to develop an interlinked and very sustainable African financial system, which can actually be able to navigate through some of these challenges we are facing in accessing capital. In my view, it would be easier for us to access, for example, capital from a Nigerian lender. Why? Because probably we face the same kind of challenges, and Nigerian investors have come to understand the kind of challenges that most African countries face, and it is easier for them to navigate than to have someone probably sitting in an offshore office, which is based off the continent, to actually assess the risks that are associated to lending to an African-based financial institution.
I agree. I cannot agree anymore. We need to build a resilient and strong financial system in Africa. But that turns to financial literacy and inclusion, which has remained a worrying subject and will be critical for any rebuild during and post this pandemic. And I'd like to turn to Mr. Ashade. Financial literacy and financial inclusion have been growing concerns in Africa's financial system. According to FINA, 36.8% of the adult Nigerian population are financially excluded. In comparison, it is 27% in Kenya and 52% in Ghana. At a time when governments and stakeholders are hoping to improve financial inclusion, the pandemic poses new threats to expanding financial inclusion and literacy. What do you think these threats are, and what would, in your opinion, be the practical remedy to this?
Thank you so much, Chijioke. It's a pleasure being here. I totally agree with you that the impact of the COVID would definitely affect the expansion of the financial inclusion and literacy across Africa, not to even underpin into Nigeria, because it is noted for any financial independence across any major country, especially within Africa, there is need for the financial inclusion and literacy. So now, having been beaten, resulting from the impact of this COVID, there's some identified issues that is going to come resulting from that. Number one, we talk about cyber attacks, because what's the implication of what has happened now will mean a paradigm shift in the model and the mode of presenting this opportunity to the less privileged and the sector of the market or segment of the market that is being addressed. So resulting from that, as you will see today, most of the operation has been remotely presented in terms of services across bank and non-bank financial institutions. So resulting, it will now lead to the financial services that is going to be having on a platform, a digital platform, which will mean more fraud. Resulting from that, even the digital payment infrastructure that is in place will need to be revamped to allow, more detailed impact across the selected group. Again, this will lead to operational risk, as it were, as it's going to affect the system capability and the constraint that is going to have across board. The second one, we look at the KYC crisis. KYC issues will now come to bear. Now, there will be tension between quickly easing the access to mobile payment, which, several countries will have done in response to COVID-19 crisis. And this, again, will maintain the issue about knowing your customer appropriately, the procedure that has been on before post-COVID, before COVID, that's pre-COVID, and post-COVID will totally be different because the model of presentation of services across board is changed. Again, that will affect the AML compliance too. Also, you look at the increase in the cost of service. This is quite very key because when looking at the financial inclusion, most of the organizations are adopting the agents base, and they are now relying on rebalancing through going to ATM to get some funds to do that. That now snowball into additional cost in terms of servicing the segment of the market. And finally, I want to look at the increase, income and gender inequality. A survey has shown that developing countries are 23% less likely to have internet. That is in terms of the women in financial inclusion, that 23% less likely to access the internet base, like in terms of mobile phone, than their men counterpart. So what that will mean that at that particular point in time, both the urban population and the rural population will create a gender gaps. And because of the gender gaps in these countries, the access to digital financial services will be challenging for the poor and the elderly. Because so that means that the original objective of financial independence that will lead to the issue ab initio will be affected. And quickly, I look at the remedies that we look at from the financial institution standpoint. So having this from the cyber attack to KY issues and to the gender inequalities. One of the remedies that the bank will put in place or the financial services provider across board will be the need to upscale their operational risk scenario analysis, which is very key. And they will now, in doing that, they want to do planning policies, their procedure in line with the recent development. This is a total paradigm shift. So every organization that must succeed beyond now must be able to put appropriate policies in place as to guide the new ways of presenting the service delivery and to capture the data of the customer. Also, the institution needs to assess the adequacy of the internal control, which is very key. The internal control, now the new working arrangement has changed. Most of these working arrangements, we have more people working remotely than being on ground in the offices now. So the internal control system must be looked at, looking at the security awareness among staff, looking at the customers in terms of their email, text messages, and other medium that will be used is very key. And in addition to that, to the sensitive nature of the opportunities that the pandemic has created is very important. And what it means is that financial institutions must learn on the new way of collecting and analyzing the relevant data that is required here to use to create innovative products for the financially inclusive segment that we're talking about.
Thank you, Mr. Ashade. You mentioned data about 7 times, if I got my count correct. And so it just shows you the importance of data as we move out of where we find ourselves in. But I'll come back to you very shortly, Mr. Ashade, because I want you to also speak to the issue of insurance and how the people can get more people on board insurance products as we see financial literacy and inclusion. But I'd like to bring Mr. Suleiman into this subject very quickly. And speaking to data, the financial system is being flooded with data-related demands. On one hand, financial institutions need to harness the potentials from data analytics, database integration, risk profiling, credit rating, something that Mr. Ashade has talked about, and I think also he talked about Dr. about as well, because they need to respond to customer needs and peculiarities. On the other hand, regulatory authorities burden financial institutions with data requirements. Know your customer checks, illicit financial flow reports, global information requirements, etc. I know we're seeing this a lot in Nigeria. This has led to cumbersome account opening information requests. How best can a bank manage its data demands through the COVID-19 period? Could the request for this data discourage the rural community, which I also hear Dr. Ashade and Mr. Ashade talk about, rural community from participating in financial inclusion?
Okay, thank you, Chijioke. I would like to start with the last leg of the question, which is the demand for data by the regulators. Will it affect our ability to include rural communities in financial services? And the answer is a simple no. The regulators have actually been quite proactive in sort of dissecting between those who need basic financial services and those who have access to complex financial products and therefore needs more monitoring. And so the need for you to include someone in the rural community today or someone who is transacting less than $1,000 through their account is quite basic. And I think in no way will the demand for data affect our ability to include them. That said, I would sort of add to that by saying the biggest challenge we face with financial inclusion is not the number of people who are excluded. It is actually the fact that those who are included are not receiving any product or services that enhances their quality of life in a significant way. So when you look at the primary need for capital, whether it is the need for people to be able to leverage and grow their business, or the need for people to be able to take more risk because they have insurance, or they need to be able to invest and grow wealth. We are not doing enough for those who are included. And so there is no real motivation for those who are excluded to rush into financial inclusion of financial services. Going back to the original question about what the data economy means for us. On the business side, I think we are more challenged by our inability to truly understand what the data really means. So first and foremost, the data is generally not organized as we would like, and we have not yet developed the capacity to organize the data. And where we do manage to achieve that, we still are in the infancy in terms of interpreting that data and gaining insight. And finally, when we do have some insight, unfortunately, we still have a deficit of products that actually solves the problem the customers are looking to solve. So there is a business conversation around how we organize our data, how we interpret the data, and how eventually we start to create products that solves for the business need. And finally, going to the topic around the demand for data for compliance. I think the solution lies in closing our ecosystem, meaning that when it comes to identity data and all the financial information that attach to identity data, we need to run a system that is closed so that we are not exposed either to the cybersecurity issues that Mr. Ashade raised earlier, or the expensive or the really expensive cost of meeting reporting needs when the data system is open and you have people coming in without sort of passing through basic requirements. The biometric verification number introduced by the banks and the central bank is a very good measure, for instance, of aggregating multiple identities under a single person, a single number, and therefore be able to tie the person to all their financial transaction. If we focus more on gatekeeping, so that people don't come into the financial system until we actually have established their identity, it is so much easier to do all of the reporting that is required, whether it is for illicit financial flows or for corruption, or whether it is really to just trace the identity of the person for the purpose of debt collection. All of that is easy when you gatekeep properly. And I think we have a system in Nigeria that other African countries can copy, where that single BVN or biometric verification number identifies you and allows you, and it makes reporting really easy, even across multiple platforms from various banks and non-bank financial institutions.
Okay, there's a lot of questions I have around your comments, but for time, I'd like to quickly go back to Mr. Ashade to speak about insurance. That's also something you begin to hear a lot by people who have been impacted by the health crisis, directly by the health crisis. And the question here would be, apart from South Africa, for instance, Mr. Ashade, which has one of the highest insurance penetration rates in the world, insurance penetration remains very low in most African markets. Specifically, South Africa accounts for more than 80% of the continent's total gross premium, according to a Deloitte 2017 report. How can insurance penetration be promoted across the rest of Africa? Is the health crisis expected to boost health and life insurance activities post-pandemic?
Well, thank you so much once again, Chijioke. I think let me start from the last one that says whether the health crisis is likely to boost health and insurance activity post-pandemic. There is no other way. Sincerely, I can tell you that definitely the health crisis has snowballed into a major crisis globally. And this is likely to boost the health and insurance post-COVID, the activity across the region. In fact, it's already happening, and you see most people are now interested in, securing themselves, taking their health more seriously, and this again will really help the insurance sector. But going to the earlier part that talks about the penetration of insurance products in most African countries, aside South Africa. And what we'll look at is let's quickly assess what are those facts or factors that is working for, or the key drivers that will say that is working for the insurance business in South Africa. The key ones you want to look at, we'll look at it from I've identified 5 key areas that we're going to do that. The first one is to look at the marketing and the distribution. When you look at the insurance businesses across South Africa, you see in their digital direct, personalized, contextual, and social engaging, is very key. And this enables them to penetrate to the various sectors across the economy. When you look at their servicing and operations too, it's user-centric with omnichannel presence. So this, is giving them quite simple, seamless, and service-friendly. This is really very key as another key driver that is working for this company. When you look at the product and underwriting, quick speed to market, very fine, driven by consumer needs in terms of their lifestyle, internal and external. So this is very, very key. And number 4, we talk about the claim and the payment. These are automated, fast turnaround, leveraging an objective of the available data. So, these also, the 51 talks about the risk management, the impact of proactive risk management, risk occurrence monitoring, and all this. These are work positively for the insurance company in South Africa, and has created a lot of things. And when you look at that, in the quest of the opportunity that the health crisis will create post-COVID, I think more insurance companies need to be, innovative in their approach. And on this note, turn out, more new products that addresses the lifestyle and the health needs across board. And so, because when you do that, this will, give an increase in the penetration across the bandwidth. And when you look at that too, part of what the sector could come up with is a rapid adoption of financial technology, whereby the insurance will upscale in terms of the new innovations to work with other businesses. So rather than looking at their sector and sector alone, they want to see what can they do together with other sector, the telecom sector, the other financial services provider, the sector, and other lifestyle related sectors or organizations. And they want to see where and how things could work together. Again, that speaks to partnership and collaboration, which is very, very key if any impact is going to be made alongside. And so in terms of mass sensitization, which is very key, the industry players need to really break insurance down into simple language that can be spoken and understood by common man. Most of the reason why we have apathy in terms of buying insurance product is the knowledge gap between the user of the product and the product itself. So they need to really come to terms with the fact that the understanding of the segment of the market of the product, and that is why their product development should come from the need analysis and the opportunity that the post-COVID has offered the sector to be able to tap into that. Again, we look at micro group insurance, agreements, uninsured, underinsured markets they can come together and have opportunity, not only within our region, but outside our region, that will create micro insurance to sell low products to the low income market. This is happening like in Kenya. You see micro insurance health products that's being sold in that. And in addition to that, we want to look at the transparency, accountability, and prompt payment of insurance claim. I talk about the major success factor, as you see in terms of the insurance company in South Africa. This is very key for our insurance to see the need for them to pay their prompt claims is very key. The accountability, the transparency, all that. But finally, let's come to think about I talk about the recapitalization of the industry. I know the regulator of the insurance business, they are already doing something. I think they'll be giving up till next year to ensure that most of the insurance companies, they are being capitalized. This is very, very critical because aside South Africa, the insurance company in many African country market, they lack capacity in terms of their financial something. And this is not, when it's not adequate, there is a way it can rub off on their provision of the required services. One of the advantage of recapitalization will mean it to enhance the capability of the insurance company to be able to support some big time transaction as they develop new vista across various sectors that is being established. So it's very key if they must engage in across the board, taking advantage of the opportunity that post-COVID has provided. I think it would be nice for our insurance company to imbibe all this and look at critically how to take advantage of all these key areas. Thank you.
Thank you, Mr. Ashade. But just a quick one. But from where you sit, are you beginning to see maybe not a purchase of more insurance products, but the interest increase for insurance products in Nigeria, for instance?
Well, yes. Where I see it, I could see there will be a lot of increase because now you see that there will be growth in the HMOs. As against before, now you now see advert of HMO coming on board. So because there is a direct correlation between when people now start, giving interest or attention to their health, what that will mean is for the insurance sector to now see one as an opportunity to see what can we do differently in this space to enable us take advantage of this opportunity that has come our way. How different products that we can develop to ensure that as we come out to address the need of this, so that is about coming from the need basis product development. So we now say that these people will now come up and say, I will need this, I will need this, this area is lacking, and they have no products or even existing products that is yet to be known to the market. So they'll be doing more of marketing of the existing product while they were engaged in more product development. Because this is when and why they take into consideration the mass sensitization. I think with those three, there will be depth in terms of the insurance coverage in Nigeria.
Thank you so much, Mr. Ashade. That's so comprehensive about insurance. I would like to just look at some other disruptions that have been there pre-COVID, have been gradually getting more visible, especially in Africa. And I'd like to turn to Dr. Chileshe and look at the discourse around emerging technologies. So look at things like cryptocurrency, blockchain, which are becoming the foundation of the future financial system. Several regulatory authorities overseeing the financial system in Africa have not embraced these technologies, despite its growing adoption around the world. What do you think is causing this posture by the regulatory authorities? It's a matter of when and not if. How should the financial system prepare for this change?
Chijioke, I'll start by answering your last question. The question is, I think it's a matter of when. I think cryptocurrencies as well as blockchain services are already on the continent, but it's an issue of many of our regulatory authorities which are still facing challenges to embrace these new technologies on the continent. One thing that I think I've seen amongst our regulators is that they are not being proactive in responding to changes in the digital space by having to develop regulatory systems that adapt to the new way of doing things. So in my view, one of the factors that has been hindering, especially amongst African countries, is lack of a regulatory framework to deal with cryptocurrencies as well as blockchain technologies. So as time evolves, I believe quite a number of African central banks and other regulators in the financial services industry will embrace these technologies as more and more of their staff embrace the resources. There's also a need for many of our central banks to invest more in infrastructure that deals with these issues. The other thing I guess which is really a problem is the level of the skills set. I think amongst most of the central bankers as well as financial services regulators, what you tend to see is really a situation where we are always doing a catch-up. I was in the central bank for quite some time, and I can clearly see that the African continent generally tends to lag behind most of the developments in other continents, and they tend to do a catch-up, and probably sometimes the catch-up is so fast that probably quite a number of nitty-gritties are left away without being dealt with, and that creates quite a lot of problems with the regulators. So I guess the most important thing for now, I think the regulators need to start investing massively into infrastructure as well as regulatory skills that pertain to digital financial services, especially more complicated services such as cryptocurrencies. So it's really important that we embrace the new systems before we start doing a quick catch up and patch up, which could actually go very, very wrong for us on the continent if we don't embrace it now when everyone else is actually implementing it.
Thank you, Mr. Chileshe. I will not ask any questions on that because I mean I'm also struggling with issues around blockchain, cryptocurrency, and I guess that everyone is trying to get abreast of these emerging technologies and how it would impact us.
Yeah,
Mr. Chileshe, you want to say something?
Yeah, one thing I wanted to say was another issue is that generally, I think with regards to technology, we tend to lag a bit behind. Generally, not only the regulators, I guess even the private sector is much more still grappling with the cryptocurrencies. And you've seen how we've lagged behind with regards to other set of digital financial services to become entrenched on the continent because probably lack of access to technology, which is still a big problem on the African continent. And as we embrace more and more of ICTs, I guess it will be easier to implement newer technologies than it has been in the past.
Okay, thank you so much, Dr. Chileshe. I think we cannot conclude, we cannot talk about, the finance session and how to recover without talking about solutions. And so to come back to Dr. Gilpin, several regional economic communities are, as we speak, deliberating on ways to help members overcome the economic challenges caused by the pandemic. What do you think should be at the top of this plan? And how do you think such plans should be implemented at a regional level? Dr. Gilpin, I think you're still muted. You need to unmute.
Thank you so much, Doc. I think it's been quite an interesting discussion and a lot of issues have been raised. And I think this is a good pivot for us to reposition ourselves and maybe help to streamline Africa post-COVID. One of the key areas that actually have come up is I wouldn't want to use the word prohibition, but there has been an instruction for banks not to pay dividend until next year. So this is one way to help to stabilize, the sector in the face of what we will call the unknown, consequence of the pandemic. Two, the capital base, strengthening and deepening the capital base in the face of the uncertainty about COVID. Three, the issue about forbearance and also managing, intermediation during the crisis. I also believe that one thing that the region could do is to help in pushing out the digital portal. This is quite important because in the absence of face-to-face banking or the conventional banking, which has actually been impacted by COVID, we do need to hop on the digital space. That one will not only improve access to finance, will not only improve account penetration, it will also improve financial depth and also financial transactions. I believe that as a region, we can have policies that can enable us to be able to interact with the financial base country by country. Also be able to work with banks, which African, Pan-African banks, makes it easier because then you have, for example, the ZANACO bank in 50 countries or 40 countries, and you have other banks like my bank, which is actually a local bank, which has a desire to expand, and we can then work upon similar policies. We can work upon similar type of platform to push financial stabilization, financial growth, access to finance, financial depth across the continent in a harmonized manner. I think there are critical things which we need to look at. Let's say one is account penetration. How can we work on that as Africans? How can we work on that post-COVID? The fact that COVID has made us realize that face-to-face banking is good, it's traditional, but it is gradually evaporating, or it's not evaporating, it is diminishing. We need to find the alternative. And I think we need to have that coordination across countries. One area that maybe I can say we do lack coordination really is really in the financial sector. Africa needs to coordinate a lot more in the financial sector. So transfer of funds, access to accounts, remittances can be done rather seamlessly, either through a card like the Valve card or your Visa card, or a debit card that you can utilize in as many countries as you can, and also the access to your accounts through your phone. So I think Africa needs to coordinate on establishing a portal wherein Africans can access their funds within countries with ease, and that will not only help in strengthening the financial sector, in also strengthening financial integration, but also will help to boost economic growth across the region and across the continent.
Thank you so much, Dr. Gilpin. I hear that we have lots of questions. Perhaps we just take one. And understand the question from Mrs. Oko to Mr. Suleiman. So, Mrs. Oko, if you're there, if you could ask the question. Mrs. Oko, we can't hear you. We can't hear you. Mrs. Oko, we still can't hear you. Maybe if you could send the question across, I could help ask it. Let's try one more time. Mrs. Oko, can you? I think we have some technical difficulties.
But Chijioke, can I then lean into Dr. Gilpin's last comment?
Okay, maybe what I should do is let me take Mrs. Oko. I think I have Mrs. Oko's question now. Let me take Mrs. Oko's question, and you can lean into and answer the question at the same time. So, the question is, okay, yeah, lots of financial institutions suffered a lot during this pandemic. Mr. Suleiman, how can we re-strategize to mitigate the losses and improve or avoid future damage? That's
okay. So if I heard the question correctly, it is about what we can do to get out of the losses suffered as a result of the financial meltdown. My sense is that we have not had a financial crisis yet, and I think I'm still hopeful that that can be avoided. We do have a significant economic slowdown, and there are two concerns that one should pay attention to, two areas one should pay attention to. The first one is the weak demand arising from people who have become unemployed and therefore no longer able to consume, and from people who, even though are employed, have now gone into the sort of reaction you would expect when people are worried about the future, and therefore aggregate demand is weakening. So the response to that is to continue with what the government has started by getting resources across to the most vulnerable so that they can continue to consume and hopefully keep the economy humming. But at the same time, on those who are still employed, we need to give them access to financial products that will give them some level of comfort. And this could be aggressively pushing insurance, as Dr. Ashade has talked about, so that on the back of the comfort arising from either health insurance or life insurance, people are then able to consume more. So that's on one side. The second concern that I have, it's about the supply side. And one of the bottlenecks on the supply side is access to foreign currency. And that arises from our dependence for input, for for IPs, for franchises, from abroad, and where we don't have the foreign currency to support that payment, then we start to struggle, and local production suffers. So our response has to be to moderate those dependencies, so that the things that we don't have to import, we need to aggressively begin to make them here, so that the available resources is then used for the things that we cannot yet produce. So those are the responses, both short and medium term. And I hope that answers Mrs. Oko's question. Regarding what Dr. Gilpin spoke about, I think the biggest challenge we face in Africa, it's that the regulators are not allowing enough room for operators to experiment. So a lot of the technologies that we are all going on about now are the result of micro-experiment in other jurisdictions, either because those experiments are carried out outside the mandate of the regulated entities, or where the regulators permit some level of limited experimentation. So I think our regulators need to understand that the concept of the sandbox and some level of limited experimentation is critical if we are to compete in evolving technologies. I can tell you for free that all of the technologies in question, including digital fiat currency and crypto, can very easily be deployed out of Lagos today. We have the platforms, we have the tech stack, we have the people who can build them. But if you don't allow the experimentation, then there is no learning. If there is no learning, there is nothing to regulate, right? So because it's all the product of R&D, and the regulators are not going to do the R&D. And if we wait for the regulators to be ready for regulation before allowing the R&D, then it's way too late. So if I have one advice for regulators across Africa, please allow limited research, limited experimentation in emerging technology within your various jurisdictions, because it will give you an advantage when this becomes the inevitable platform for global trade or for global payments.
Thank you so much, Mr. Suleiman. Fortunately, we don't have time for more questions. But that's all the questions we can take. But I think it's clear we have some visibility into what some of the issues are, what Africa or Africans need to do collectively to finally turn the corner. Before we go, I'd like to ask well, maybe we don't have time for that, but but I thank our distinguished panel for the time, for the insight into this. I'd like to also thank the organizers for this, and thanks for the opportunity to moderate this session. We hope to have the panelists back in future to discuss this subject, hopefully speaking about a much improved financial system in Africa. It has been a privilege and absolute pleasure moderating this session. Thank you so much. I hand over back to Moses to take it from here.
Well,
thank you.
Thank you very much, Chijioke, for that lovely moderation. Ladies and gentlemen, there you have it. It's been a wonderful, insightful session, but we would not move on to the next phase without thanking our speakers for delving into the discourse in-depthly and not just on the surface. Thank you very much, Mukwandi Chibesakunda, CEO Zambia National Commercial Bank PLC, represented by Dr. Patrick Chileshe, Head of Economic Research, ZANACO Bank, Zambia. Thank you very much goes to also Group Managing Director, Chief Executive Officer, Sterling Bank PLC, Abubakar Suleiman. We also thank Peter Ashade, the Chief Executive Officer, United Capital PLC, and also not forgetting Dr. Walton Gilpin, the Chief Executive Officer, Rokel Commercial Bank Syria Leone, and also to thank our moderator, Global Trade Advisor, Deloitte West Africa, Chijioke Odo. Thank you.